What's currently the most desirable location in Sydney? The result may surprise you, but you're going to find out in this week's show. And we're also going to have a chat about the concept of rent vesting. Should you rent and invest in property, or should you buy your home first? And again, the result may surprise you. So welcome to this week's show. I look forward to sharing these ideas with you.
Are you interested in property investing, success or money? Well, you're in the right place. This is the Michael Yardney podcast, where each week you'll learn a number of new ideas regarding success, property investment and money in 20 minutes or less. Our show is brought to you by Metropol, who specialise in helping you grow, protect and pass on your wealth through strategic property advice. Now here's your host, Michael Yardney, who has once again been voted Australia's leading property investment advisor. That's the fourth time he's won a similar award in the last 6 years.
Today's show has a bit of a Sydney focus, but the principles we're going to discuss will be relevant to everyone who's interested in investing in property. So I think you're going to enjoy it. Because firstly, we're going to discuss what is currently the most desirable location in Sydney. And the answer may surprise you. Look, areas like the eastern suburbs of Sydney or the lower North Shore may immediately spring to mind. And yes, they've been and they're going to continue to be desirable due to their affluence. However, there's no doubt that the underestimated location that we're going to discuss, which has long been the underdog, is now dominating livability studies due to its cultural amenities, transport options and great value. Have you figured out where it is yet? Well, in a moment I'm going to be speaking with Ahmed Imam, Director of Metropolitan Properties in Sydney, and he's going to reveal our research. Then we're going to talk about the option of should you rent or should you buy. Now that's a question facing many Sydney-siders because of rising prices and difficulty with affordability. But it's not only Sydney, so this is happening all over Australia as property prices are rising and first-home buyers are finding it harder to get in the market. So many are considering renting a property where they want to be near their work and investing where they can afford to. Now, I know the traditional belief's been rent money's dead money, and that's a sticking point for some people doing this rent vesting. But interestingly, if your rent vesting will allow you to use some of your spare money to buy property. So is it cheaper to buy a home or to rent vest in Sydney? Now, finder.com.au crunched the numbers to find out. And in the second part of the show, I'm going to be speaking with Graham Cook, the Insights Manager, to share their findings. And they may surprise you. For many people, rent vesting in Sydney, in other words, renting somewhere to live and buying an investment property somewhere else, can come out a much, much better financial decision than if you buy your own home straight away. And as I said, even if you're not interested in the Sydney property market, the information and principles we're going to discuss in both my chats today are going to be very relevant wherever you're looking to invest. So let's get on with the show. Now, we know the Sydney property market is down but not out. So if one wants to take advantage of the opportunities the Sydney market's offering at the moment without as much competition, where should you buy? What's going to be a desirable location in the long term? To get a better understanding of this, we're going to have a chat with Ahmed Imam, Manager of Metropolitan Property Strategists in Sydney. Welcome, Ahmed.
Hi, Michael. Pleasure to be here.
So there's lots of great locations. It's a very pretty city. But if you had to pin down one location, what would be the most desirable location in Sydney, Ahmed?
Well, the answer may surprise you, Michael. And areas like the eastern suburbs of Sydney or the lower North Shore may immediately spring to mind for a lot of people. And yes, they have been and will always continue to be desirable due to their affluence. However, there is no doubt that this area that has long been the underdog is now dominating livability studies due to its cultural amenities, the transport options, and the great value. And the area that I'm referring to is the inner west of Sydney.
So what would you class as the inner west, Ahmed?
Well, the inner west is the metropolitan area that's directly due west of Sydney CBD. It extends from suburbs like Dulwich Hill to Newtown, from Leichardt to Balmain. It's really emerged as Sydney's liveliest and most livable precinct. And right now, Michael, for many prospective buyers, it's actually their top pick, above the eastern suburbs and above the lower North Shore areas.
Well, I remember we've been buying properties for clients in the inner west for well over a decade. We've bought hundreds and hundreds. And when I was first introduced to it in 2008 and drove through it, it really was an emerging gentrifying area. It was an old working class area that has now come of age. So what makes it so desirable today?
There's a few reasons. First of all, love it or hate it, the inner west has the reputation of being the most liberal, socialist, green, intellectual part of Sydney. And accordingly, like you mentioned, Michael, the area has become increasingly gentrified over the past decade. The other main reason is based on all the talk about affordability constraints right now, it's the value that you get out of the inner west. The inner west shares the same livability and similar cultural amenities to the affluent areas like the eastern suburbs and the lower North Shore, but at a much more affordable price point, making it fantastic value. So owner-occupiers, investors, first-home buyers are finding that their money really stretches further in the inner west at the moment.
Okay, thinking as an investor, in your mind, what would make a good investment-grade property in the inner west?
Well, in the inner west, you have to have the right expectation. Depending on the price point, it's difficult to expect a house. But we do have options of apartments, terraces, small houses. The entry level for an investment grade apartment, let's say in the inner west at the moment, is $600,000. So at $600,000, you can get yourself an apartment that ticks all the boxes, meets all of our criteria.
So you're talking about apartments, Ahmed, as opposed to semis or houses, but the way one lives in Sydney has evolved, so more people are happy and expecting to live in apartments in Sydney as they would in any other major metropolis in the world. In fact, that's interesting because the inner west is actually one of Sydney's older areas, isn't it?
It is. And you'll notice it just by driving through, as you mentioned. The architecture ranges from Art Deco apartments to terraced houses, to small mansions, and they all reflect their development in the Victorian and Federation periods, which actually dates back to the 1860s. So this adds to the inner west's appeal, its scarcity value, and it's got this historic charm about it.
That's what will remain for quite some time. That's one of the attractions of that area, rather than some other parts of Sydney and other capital cities where there are huge high-rise complexes that dominate the streetscape. What about transport to that location, though, Ahmed?
It's one of the few local government areas that actually has access to all bus, ferry, light rail, train. It's got many cycle paths. The light rail allows you to travel from Dulwich Hill to the city. The buses are everywhere. I mean, quite literally every block, and they're very frequent. The Inner West train line is now connecting even more suburbs, and the locals in Balmain and Rozelle can actually catch a ferry to the CBD. So the transport infrastructure in the Inner West has never been stronger.
Well, that's really, really important because as Sydney has now hit the 5 million people mark and is going to keep growing, proximity to good infrastructure, proximity to public transport, walkability is going to be more and more important because, admit it or not, Ahmed, the roads system isn't really that good in Sydney, is it? No,
it's absolute organised chaos at the moment. So,
except you can listen to my podcast when you're in the car the whole time, can't you?
That is a benefit, yes.
So, Ahmed, how do you see the Inner West performing over the next few years?
Well, we always take our top-down approach, and just like Sydney as a whole, the Inner West is also fragmented. So there are certain pockets of the Inner West that we really like, and there are other areas that we wouldn't necessarily touch. But the Inner West has proven as a whole to be an investment-grade area. So it's an area that is strong in that it has wealth-building rates of growth, but it's also proven to be stable. So even in times like this, it doesn't actually fluctuate in value too much because it has those local economic growth drivers that we need as fundamentals. We've had auction clearance rates reduce over the last few months, Michael. We've gone from auction clearance rates as a whole in Sydney of about 70%, and wider Sydney is now reflecting auction clearance rates of around 50%. However, auction clearance rates in the Inner West is still showing 70% plus, which reflects strong demand. Any market slowdown in Sydney over the coming years won't really affect the Inner West's long-term growth prospects because all the long-term fundamentals for growth are there, and we're seeing significant urban regeneration, which we discussed earlier, which will further support that growth.
I think more than that, the supply-demand ratio is such that there are more people wanting to live there with a lack of supply. So I think it's a really, really important lesson that comes out of this, Ahmed, that even though the Sydney property market has flattened, there isn't one Sydney property market. And as you say, it's very fragmented. And there are some areas that have always held up in downturns, and these are the areas that have got a larger percentage of owner-occupiers and actually more affluent owner-occupiers, and that are gentrifying and that people are wanting to get in while they can. So if people want to understand a bit more about what to buy in Sydney in particular, or the inner west, how would they contact you?
Sure. You can reach us on 1300 Metropole. Otherwise, you can check out our website, metropole.com.au. You can leave an inquiry. Our lovely people will give you a call and we'll sit down and have a chat.
They are nice people, aren't they, Ahmed? Even though I think we're both biased. So thank you very much for your time. Will be interesting to see how the Sydney market moves on over the year.
Thank you, Michael. Pleasure.
In a moment, I'm going to share with you some lessons from one of my early mentors about success. Something that I learned a lot from, and I'm sure you will as well. And then we're going to have a chat with Graham Cook, Insights Manager at Finder.com, about whether it's cheaper to rent or buy in Sydney. And even if you're not interested in the Sydney markets, some of the principles we're going to discuss are important to you. And we're also going to have a bit of a talk about how the banks are treating older home buyers because the rules are changing. But before we get on to that, I thought I'd just share with you the fact that I'm spending quite a bit of my time at the moment totally upgrading the content of my property renovations and development workshop. I do this once a year, annually. I've been doing it since 2003. It's Australia's most advanced property training if you want to become a property renovator or property developer. I used to call it my real-world real estate workshop because it had real-world advice from real-world people who are doing it today, not from reality TV type stuff. So if you want to step up to the big league, why not spend 2 days, October 20th and 21st, with some of the sharpest minds in Australia, and we're going to show you some proven systems and strategies for property investment, the sort of things that are going to work at this stage of the cycle, because we're going to teach you how to invest in like the pros by getting started with property renovations. And if you're interested in property development, we're going to give you all our internal checklists and notes and my book on property development that you can't get anywhere else. And it's going to come from me and my team. Bryce Yardney, my son's actually currently involved project managing over 50 development projects. Greg Hankinson, my partner in Metropole Constructions, was involved in 70 renovations last year. We're going to have 2 finance strategists. Ken Race is going to talk about setting up the right structures. So we're not going to teach you how to get a discount card at Bunnings. We're going to teach you the business of property development. We're not going to teach you how to lay one brick upon another. We're going to teach you how to be the project manager of your development. By doing that, you're going to be able to manufacture capital growth. You're going to be able to generate strong rental returns so you can win in today's challenging market. So if you want to take your property investment to a whole new level, go to realestateworkshop.com.au, find out about all the bonuses you're going to get as an early bird purchaser, find out about my money-back guarantee, and how you're going to be able to have a one-on-one implementation session with me. Now, this is a training event. It's not a selling event. So this is the year to come. Don't put it off, because this is the year that you need to take your investing to the next level to beat these awkward markets. Well, with that ad out of the way, let's move on with my mindset moment.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
Success is easy. Well, that was the message from one of my early mentors, Jim Rohn. But he also said, so is neglect. Neglect is easy. Now, I learned a lot from Jim Rohn over the years, so I'd like to share one of his articles with you. Unfortunately, Jim Rohn has passed away, but his articles, his videos, his blogs are still around. So let me read one out to you that he called Success is Easy, but So is Neglect. And Jim Rohn said, people often ask me how I became successful in that 6-year period of time, while many of the people I knew did not. And Jim said, the answer is simple. The things I found easy to do, they found easy not to do. He said, I found it easy to set the goals that could change my life. They found it easy not to. I found it easy to read the books that could affect my thinking and my ideas. They found it easy not to. Jim Rohn said, I found it easy to attend the classes and the seminars and to get around other successful people. They said it probably really wouldn't matter. Jim Rohn said, if I had to sum it up, I'd say what I found easy to do, they found easy not to do. 6 years later, I'm a millionaire, and they're still blaming the economy, the government, the company policies, yet they neglected to do the basic easy things. Jim said, in fact, the primary reason most people are not doing as well as they could and should can be summed up in a single word: neglect. Jim Rohn said, it's not lack of money. Banks are full of money. It's not lack of opportunity. America and much of the free world continues to offer the most unprecedented and abundant opportunities in the last 6,000 years of recorded history. Jim said, it's not the lack of books. Libraries are full of books and they're free. It's not the schools. The classrooms are full of good teachers. We've got plenty of ministers, leaders, counsellors and advisors. Jim Rohn said, everything we would ever need to become rich and powerful and sophisticated is within our reach. The major reason that so few take advantage of all that we have is simply neglect. Neglect is like an infection. Well, that's what Jim Rohn said, and I agree with him. He went on to say, left unchecked, it'll spread throughout our entire system of disciplines and eventually lead to a complete breakdown of a potentially joy-filled and prosperous human life. Not doing the things we know we should do causes us to feel guilty, and guilt leads to an erosion of self-confidence. And as our self-confidence diminishes, so does our level of activity. And as our activity diminishes, our results inevitably decline. And as our results suffer, our attitude begins to weaken. And as our attitude begins to slowly shift from positive to negative, our self-confidence diminishes even more. And on it goes. So Jim Rohn's suggestion was that when given the choice of easy to or easy not to, that you don't neglect to do the simple, basic, easy, but potentially life-changing activities and disciplines. Interesting words, powerful words, fits in with the philosophy that you've probably read in my book, Rich Habits, Poor Habits. Successful people have rich habits that they do every day. They think in a particular way that gives them certain results and gives them the life that they deserve. A great message for this week from Jim Rohn. Success is easy, but so is neglect. There's a lot of fuss made about affordability for first-home buyers today. In fact, there's always a lot of fuss made about affordability for first-home buyers. Now, even if you're not looking to buy your first home and you've got a home or you're a property investor, I think what we're going to chat about is going to be very interesting for you. One of the things I want to point out is that it's always been hard for first-home buyers, and study after study has shown it's really not harder today than it was 40, 50 years ago. But I think we're going to have more fuss about affordability in the media over the next little while as the next federal election creeps up. Another interesting statistic is that the percentage of Australians who own their own home is dropping. But it may not be because of affordability. It could well be because of certain lifestyle choices, which I'm going to chat about in a moment with Graham Cook, the Insights Manager at finder.com.au. When I bought my first home, bought my first investments, I was really happy if interest rates were below 10%. They were usually just above 10%. Of course, inflation was higher at that time as well. And in those days, you needed 30% deposit and you needed to have a savings history with the bank. You actually had to prove your savings record. And in the 60s and 50s, and also a little bit in the early 70s, your spouse, your wife's salary wasn't accepted for serviceability. Now, another big factor is that today homes are probably twice the size that they were then. But despite that, because of the very low interest rates, houses are more affordable when you work out people's disposable income and the fact that they're paying half the interest rate they did 10 years ago. So today, many millennials have to make a lifestyle decision. They've actually chosen to live close to the city, close to the action, close to the work, close to amenities, but they still want to own property, so they tend to rent where they want to live and buy investments where they can afford to. That's the concept of rent vesting that I'm going to have a bit of a chat with Graham Cook about. The other thing is many millennials are getting married later, having their children later, and they don't seem to need the family home as early as older generations, but clearly they still want to own property. Others are just looking for freedom and don't want to tie down their roots for long periods of time. So again, many are happy to rent for longer periods of time before they own their own home. Now, of course, overseas, the trend to lease properties for long periods of time, not just 1 or 2 years, but 10 years, is very common. You look at it in Canada, in Germany, in the Americas, they often take 10-year leases. But I wanted to understand what is actually cheaper, what's better on your cash flow, to buy a home or lease a home. And that's what I'm going to discuss today with Graham Cook, Insights Manager at finder.com.au, because he looked at the question, and when he did the sums, a blog on their website showed that it was much, much cheaper in Sydney in particular, not as much in other states, to rent rather than to own. And if you could use the difference in money to invest, boy, were you better off. So with that long intro, I'd like to welcome my guest, Graham Cook, Insights Manager of finder.com.au.
G'day, Michael. How you doing?
Good, thank you. Now, Graham, property prices continue to rise and it's becoming increasingly difficult for first-home buyers to break into the market, particularly in Sydney, our most expensive market. Now, I know this has prompted some to consider maybe you should be renting a home that could be more affordable than buying. So what's cheaper, particularly in Sydney, renting or buying?
Oh, the answer is most definitely renting, especially in big cities like Sydney. I live in the inner west in Sydney myself, and you know the median price, even for an apartment in that area, is well north of $1 million for somewhere nice. So Sydney house prices definitely pushing towards the unaffordable end. If we wanted to look at just directly comparing the cost of buying a place versus renting a place in Sydney, taking a median property price of about $1.2 million and presuming that the buyer has a 20% deposit for that home, so you'd need $240K saved before you even buy, you're talking about, with a 4% mortgage, you're talking about monthly payments there of about $4,500 per month. So that's quite a lot for any individual or family to have to shed out. If you compare that to renting in a similar area, you're talking about a rent for a month costing between $2,000 and $2,500. So definitely the answer there is that it's a lot cheaper to rent. Because of the disparity, we're seeing an awful lot of interest recently in what people are calling rent vesting.
So clearly there are some financial advantages, but let's spend a couple of minutes, Graham, working through the pros and cons of the concept of rent vesting. Let's start with the advantages. Tell us some of the advantages of rent vesting, Graham.
So there are quite a few advantages to rent vesting. The most obvious first one is that it enables you to enter the property market sooner. It would take quite a while to save that $240,000 deposit that would be required to buy a house in Sydney without paying lender's mortgage insurance. But it would take less time to save the $120K to buy an apartment. So you can get on the rung of the ladder sooner and stop paying all of your money, dead money, to renting.
Graham, I'm sure it also will afford people the opportunity to have the lifestyle they want. They're going to be able to live in those funky areas of Sydney, Melbourne, Brisbane, any of our capital cities that they just couldn't afford to own. But if you were overseas in London, in New York, Paris, any of the big capital cities, you wouldn't expect to be able to buy a property there either. You'd be happy to rent, wouldn't you?
Yeah, exactly, yeah. I mean, it also enables you to build wealth while you're renting, which a normal renting scenario wouldn't allow you to do. And as well as giving you the flexibility with where you live, it gives you flexibility with where you invest, which is probably the most important thing. You can be living in Sydney, but you could rent in outer Sydney, you could buy in outer Sydney, but you could also buy in the Gold Coast, you could buy in Adelaide, you could buy in Perth, wherever you see the markets emerging.
Now, while we all want to buy our own home, if you think about it, your first home is not likely to be your last home. So one shouldn't really get that emotionally attached about it. But rent vesting, the numbers you just told me, would give you the ability to save for your dream home, wouldn't it? You'd actually be able to own an investment property and have some money on the side, building your asset base for the future. And in our current lifestyles, Graham, it leads to the flexibility we now want.
Exactly, yeah. I mean, we're talking about the millennial generation, or the generation that wants everything and they want it now. Rent vesting kind of does give you that option if you can afford to rent somewhere and buy somewhere else.
Now, it's really interesting because tax benefits are an also important part. Graham, I've had this conversation with other people and I say, imagine we live in the same apartment building and we come out in the corridor one morning and I say, Graham, I'm sick of this. I'm paying for the owner's corporation fees and the insurance and the maintenance. I've got a deal. How about you living in my property and I'll live in yours for a year? You give me $500 a week rent and I'll give you $500. So we're sort of cash flow neutral. But all of a sudden, my owner's corporation fees are tax deductible. My insurance is tax deductible. The maintenance and other repairs are tax deductible. So there are quite some benefits, and yet the cash flow tends to be much the same.
This is true. I mean, the negative gearing situation in Australia makes it quite a favourable country in which to do this kind of investment.
And I think you've also mentioned the point that it gives you an opportunity to choose where you want to invest, because where you want to live may not be one of the high growth areas that is going to suit your investment. So, okay, we've made a number of really good points why you should consider it, but I guess there's some disadvantages, Graham.
There are some. For a lot of people, the concept of buying an investment property before you buy a property you're going to live in can feel counterintuitive. Because most people just think about their first home is where they're going to live, and that's going to be their kind of permanent place in future. But it does require a mind shift to look at investing and continuing to rent.
And there's that old concept of rent money being dead money, but you've already mentioned that that's really not the case, even though our parents probably taught us that, especially since somebody else is going to be giving you their rent money, isn't it?
Yeah, this is 100%. You're still, a proportion of what you're paying is still essentially dead money. But, you got to think of it as a sacrifice to have that lifestyle that you want. This leads us to another drawback, which for me is probably the biggest of the rent vesting scenario, because I'm actually rent vesting myself, is that you don't own the home that you're renting. So if you really love the place that you're living, if you love the area that you're living, you don't, no matter how long you stay there, you still don't own property in that area. So that can be a psychological drawback too.
And Graham, I read on your site, which has got a lot of great research information there, an interesting report which quoted ING research showing that most millennials don't even know how big a deposit they need in order to buy their first home. Was that a surprise to you?
To be honest, it wasn't. As you say, this is ING's research that we reported on. I went to the actual launch breakfast of the research earlier this week. And the overall conclusion was that millennials are not these constantly spending, not thinking of the future beings that the media seems to portray them as. Only 38% of millennials they reported were actually saving for a home, while the majority of them wanted to save for a home. But 60%, as you reported, don't actually know how much to save. There was a disparity between what they wanted to get and what they thought they should save for that. So, for example, the main house that millennials wanted to save for was a 3-bedroom home, but the deposit they thought they needed to save across the board was $76,000. Now, that wouldn't get you anywhere near what you need for a 3-bedroom home in any of the capital cities without having to also get lender's mortgage insurance. And as you know, that can cost $20,000 over the course of the loan.
So you're saying that the average millennial isn't even thinking about an apartment. They've got unrealistic expectations?
Unrealistic expectations, this is true sometimes, but the other finding from the research was that the millennials who are looking to buy and looking to invest are willing to make sacrifices. So 60% of the millennials they surveyed are willing to, for example, go through a longer commute to buy where they want to live or to cut down on expenses. So they're not, completely focused on preserving lifestyle.
Graham, the average age of first home buyers is getting older, though. This is, I guess, in due part to our changing lifestyles. We're travelling more. We're not putting our roots down as early. We're not getting married as early as we used to in the past. But affordability issues, particularly in our capital cities like we've discussed, must also be playing a part. So what difficulties might present to those who are getting onto the property ladder later in life?
This is indeed a difficult scenario. As you said, the age that people are buying properties on average has increased from 27 in the 90s to 29 around the 2000s or the noughties to 31 around the turn of the 2010s, and it's continuing to grow. It's even higher in places like Sydney and Melbourne with those huge property prices. But the thing to bear in mind here is that lenders are far more hesitant to dish out a mortgage to older buyers, especially buyers where their age the long time might encroach onto retirement age. I mean, for example, if you take out a 30-year mortgage at 35, that mortgage repayment requirement is going to continue to exist until you're 65, which for some people is the start of retirement age. So it's definitely worth thinking about getting on the ladder earlier. If you are one of those, say, 35 to 40-year-old buyers, you'll find that banks will often want to increase the security that they have over you to make sure you're going to make those repayments beyond just the security on the home. One of the things that you'll find is a regular occurrence here is they'll often want to guarantee that there will be a super payout at retirement stage to close the final amount of the loan beyond just the regular repayments. And, you can also have to take out insurance and such. So the cost increased quite a lot. So, another reason to get on the property ladder early.
No argument about that. Having said that, the $500,000 mortgage you're going to take out today in 30 years' time is going to seem a pittance when, in fact, inflation is going to be your friend. So not only will the value of your property go up, but the value of the dollars you're going to repay the mortgage with in the future are going to be worth more, so it's going to get easier. But I take your point. It really is important to get on the property ladder earlier, allowing compounding and leveraging and time to be your friend. We've seen those stories about the lily pond, that how every year the number of lilies double, but in the last year blossom so much. It's the story of compounding as well, just letting compounding increase the value of your property portfolio.
Absolutely.
So there's lots of things to consider if you want to get on the property ladder. Maybe it's worth considering reinvesting. At face value, it's a fantastic strategy for getting ahead in the property game. Of course, there's that main consideration that we just touched on a bit, the psychological concept of renting. There's also the incentives for first home buyers that help you get in the market, and the difference between feeling settled in your own home versus not being able to put pictures on the wall in a rental. So reinvesting won't be the ideal strategy for every investor, but if you're just starting out or if you're prepared to think outside the box and do things differently to get ahead, then becoming a landlord and a renter may just be the right way forward for you. Well, we're almost at the end of another show, but before we go, I want to read out a review that I recently received. But I firstly want to remind you that every review that I read out, the writer gets a copy of one of my books. You can choose which one it is. And I'd also like to ask one other quick favour. If you've got some benefit from today's show, you'd be doing me a real favour if you could pass the information on to somebody else. Every week we get hundreds of new subscribers. Our blog is amongst the most successful property blogs in Australia. Well, most successful business blogs in Australia. That's fantastic. So I'd like you to send somebody some information about it through Facebook, Twitter, send them a link, whatever. Pass them information on like I'm helping you pass it on to you. Now, today, Anish M81 sent this, put this review on iTunes, and he said, excellent and insightful. Thank you so much for sharing your knowledge and insights into investing in property. I find this refreshing and really helps in developing myself further as a person. Hope there are many more podcasts to come. Well, Anish, there are many more podcasts to come, plus there's a book coming your way, so if you email me at michael@metropol.com.au, leave me your details, I will be sending you a book in the mail, and I also look forward to speaking to you again this time next week for the Michael Yardney podcast.
Thanks for listening to this week's episode of the Michael Yardney podcast, which was brought to you by Metropol, who help their clients grow, protect and pass on their wealth through strategic property advice. If you got value from listening to this podcast, please leave us a review and we'll read it out on a future show. Just go to michaelyardneypodcast.com/review and it will take you over to iTunes where you can enter a review and let us know what you think. We'd really appreciate it. If you don't already subscribe on iTunes or on your Android phone, you'll find us there as Michael Yardney Podcast. If you'd like to gain instant access to the show notes or a transcript of the show, head across to michaelyardneypodcast.com. Watch out for our show next week. You'll learn some new ideas about property investment, success and money in around 20 minutes.